Welcome to the El Salvador SV News Podcast, a space for conversation and reflection where we explore current topics from El Salvador and the world together. You can support this project via PayPal. You'll also find details in the description of this content, or by purchasing digital content of products you might like. Check out what interests you and make a purchase. With that, you help and support us to continue providing content. You'll find all the methods in the content description. Find us on your favorite platform, on Spotify, Amazon Music, Apple Podcasts, TuneIn Radio. We're on almost all platforms as Noticias El Salvador SV. Welcome back to the Deep Dive. It is Wednesday, February 4, 2026. And I have to be honest with you, looking at the convergence of data on the desk this morning, the world just feels frozen.
That's a good word for it.
And I don't just mean that metaphorically, with liquidity drying up or market seizing. We are definitely going to talk about that.
Oh, we are.
I mean, literally, we're tracking this weather anomaly that is just shattering records. There are freezing temperatures sweeping through the tropics.
We saw those reports.
And reports of actual iguanas, falling out of trees in Florida because they've catatonically frozen. And at the exact same time, there's this distinct chill just settling over all the financial markets.
It's a rare moment, isn't it, when the atmospheric pressure and the economic pressure seem to be dropping in perfect tandem.
Exactly.
We're sitting here in early 2026, and if you just look at the charts, that exuberance, that sort of up-only energy that defined the tail end of 2025, it's hitting a structural wall.
A brick wall.
Right. And the headlines are screaming about a crash, but if you look at the underlying numbers, which is, what we do here, you see something a bit more calculated. We're moving away from the era of hype.
We are.
And we are moving very aggressively into a period where the market is demanding utility. It's a harsh reality check.
And that is exactly the mission for this deep dive. We aren't just going to list off the stock drops. We need to unpack the actual mechanism behind this correction. We're looking at a massive repricing in tech and crypto, a red Tuesday that has left a lot of portfolios bleeding red ink.
A lot of red.
We need to analyze a sovereign nation's incredibly risky, maybe even existential, double down on Bitcoin in the middle of this crash.
Yeah.
And we have to look at how artificial intelligence is finally being forced to play nice with copyright laws.
It's a packed agenda, and frankly, the connections between these disparate threads. I mean, a fintech giant losing a fifth of its value, a Central American nation buying the DEP while its citizens reject the asset, and the weather patterns.
Freezing supply chains.
Yeah, they're all tighter than you might assume. It all comes back to risk management in a hostile environment.
So, grab your coffee, or frankly, given some of the weather reports coming out of the United States of America, maybe grab a hot cocoa. We are going to explain why a major fintech giant lost nearly a fifth of its value overnight.
It's a wild story.
We'll tell you why the United States of America and the IMF are staring at a Central American crypto wallet with deep, deep concern. And yes, we promise we will explain the connection between those frozen iguanas and market volatility.
It's going to be a fascinating, if slightly chilly ride.
Let's jump right into the deep end then. Segment 1, the fintech and software stumble. The story absolutely dominating the financial news cycle is PayPal Holdings, Inc.
It was an absolute bloodbath. There's really no other way to describe it.
We are looking at a stock crash of approximately 17% following their Q4 2025 results. But before we even get to the numbers, let's just talk about the human drama here.
The C-suite chaos.
It's total chaos. We have a sudden leadership change. CEO Alex Chris is out, gone. And Enrique Lores, who was formerly over at HP, is taking over on March 1st, 2026.
Which is soon. Very soon.
Now, usually a CEO change is telegraphed. It's planned. This feels like a panic move. Chris was supposed to be the turnaround guy, wasn't he?
He absolutely was, and that's why this is so significant. When Chris came in, the whole narrative was shock and awe.
Right.
He was going to innovate PayPal back to the top. But the board's patience, it clearly evaporated. Bringing in Lores, an HP veteran, that signals a shift away from innovation and more towards stabilization.
Damage control.
Damage control, exactly. But we have to peel back the layers and ask why the market reacted this violently. A 17% drop for a mega-cap company isn't just about one bad quarter.
No.
It's a fundamental rejection of the company's entire future thesis.
But hold on, let's look at the raw numbers for a second. They reported revenue of $8.68 billion. In isolation, that is a massive amount of money. They're printing cash. So why is the market acting like they're about to go insolvent?
Because Wall Street trades on the derivative of growth, not just the absolute number. Yes, $8.68 billion is a lot, but they missed their target of $8.8 billion.
Which is never good.
It's not. But I would argue the revenue miss isn't even the smoking gun here. The scariest metric when you dig into the deep data is the branded checkout growth.
The famous yellow button.
Exactly. The Pay with PayPal button, that is their moat. It's their highest margin business. And the growth of that specific segment, it slowed to just 1%.
1%. That's basically stagnant.
It's dead in the water. Now compare that to 5% in the previous quarter. That is a massive deceleration.
It's a screeching halt.
It is. Notwithstanding the massive marketing spend, they're hitting a wall. And we have to talk about why. It's the friction war.
Explain that, the friction war.
Okay, think about your own behavior. When you're on your iPhone and you want to buy something, Apple Pay is a double click of the side button. It uses your face. It's instant.
Right, you don't even think about it.
You don't leave the app. You don't leave the page. PayPal, historically, it requires a redirect, a pop-up window. Maybe you have to log in again.
And enter a code from your phone.
Right. In a lazy economy, where every single millisecond of friction causes someone to abandon their cart, that redirect window is fatal. PayPal is losing the war for the buy button to competitors like Apple Pay and Google Pay, and on the back end, to engines like Stripe and Adyen.
So it's not even that people actively dislike PayPal, it's just that the competitors have made paying invisible.
Precisely. And the market sees this 1% growth number and it realizes the moat is drying up.
So all the talk about AI is just talk.
Well, in stark contrast to all those optimistic press releases about AI integration, the guidance for 2026 is projecting flat or even declining profit growth.
Flat growth. In 2026, that implies all this restructuring, all this pain, it isn't working.
Correct. The market is looking at PayPal and saying, you are priced like a high-growth tech stock, but you are growing like a regulated utility. And when that realization hits, the price-to-earnings ratio, it just compresses violently.
And that's the 17% drop we just saw.
That's your 17% drop.
And this isn't isolated, is it? We are seeing a kind of contagion effect here. This Red Tuesday vibe is just sweeping across the entire software sector.
It is absolutely a sector-wide repricing. I mean, look at Palo Alto Networks. This is a best-in-class cybersecurity giant.
Right. In a world full of hackers and AI threats, you would think cybersecurity is the one safe harbor.
It seems like it should be a utility at this point. Everyone needs it. You can't not have it.
Exactly.
And yet their stock dropped over 20% after they cut their revenue forecasts.
20%.
When a cybersecurity leader says, hey, companies aren't spending as much as we thought, it sends a shiver down the spine of the entire market. It's a signal that CIOs, chief information officers, are tightening their belts.
But why now? I mean, the economy in the United States of America is technically still growing. Why the sudden austerity in software spending?
It comes down to the macro environment. We're dealing with these persistent inflation fears, and consequently, the slow dawning realization that interest rates in the United States of America are going to stay higher for longer.
The soft landing isn't so soft.
It's not. And when the cost of capital is 5% or 6%, companies scrutinize every single software license. They stop signing those big 3-year mega deals.
They start asking, do we really, really need this?
Exactly. Even the giants, Salesforce, Microsoft, Adobe, they're all feeling the heat from analyst downgrades. The market is asking a very loud, very rude question to the entire software industry.
And that question is?
Where is the growth? If you can't deliver growth in a high interest rate environment, that capital just flows elsewhere.
Which brings us perfectly to the other side of the risk spectrum. Because if traditional tech stocks are struggling, usually that risk-on money flows into crypto.
Usually.
But looking at these charts, the chill has definitely reached the blockchain. Let's talk about the Bitcoin correction.
Yes, the whole digital gold narrative is facing a very severe stress test this week.
Reports are showing that Bitcoin has lost that psychological safety net of $70,000. Now, reading through the various financial disclosures, there's some volatility in the exact number.
Of course.
Some sources had it hovering near $73,000 right before the plunge. Others emphasize a drop below levels we saw back in November 2024. But the consensus is that we have breached that $70,000 floor.
And that's the key takeaway. Whether it's $69,000 or $71,000 at this exact second, the trend structure has broken.
Right.
It fell to levels we haven't seen since Donald Trump returned to the White House over a year ago. And that just wipes out an entire year of gains for some of the late entrants.
And looking at the charts, this wasn't some slow, gentle drift downwards. It really looks like it went over a cliff edge.
It was a classic liquidation cascade. This is where we need to get a little bit technical to understand the violence of the move.
Let's do it.
When Bitcoin sits at those high levels for a while, the market becomes saturated with leverage. Traders aren't just buying Bitcoin, they're buying Bitcoin with borrowed money. They're using perpetual futures contracts.
So they're betting big on the up-only thesis.
Exactly right. And they are paying a funding rate just to keep those positions open. But when the price dips, even just a few percentage points, the value of their collateral drops. If it drops below a certain threshold, the exchange automatically sells their Bitcoin to cover the loan.
And that forced sale pushes the price down even further.
Which then triggers the next guy's liquidation. And the next, it's an algorithmic domino effect. We saw hundreds of millions of dollars in long positions just wiped out in a matter of hours.
So the order book just evaporated.
It vanished. So this is a flush out of the gamblers, essentially.
In the short term, yes.
But there's a structural component to this too. We're seeing whale behavior that suggests we're in a distribution phase.
The big money is cashing out, is that what you mean?
The data suggests that large wallets, we're talking entities that accumulated Bitcoin when it was $40,000 or $50,000, are taking profits.
Which you can't blame them for.
Not at all. Albeit it's painful for the retail investor who bought the top. This is rational market behavior. If you've doubled your money and the macro environment is looking shaky with high interest rates, you take some chips off the table.
You mentioned the White House earlier. How much of this is political? We had that Trump bump when he was reelected. Has that optimism just fizzled out?
I think it's impossible to separate the money from the politics. The return of Donald Trump created a certain set of expectations. Deregulation, a pro-crypto SEC, maybe even, a national strategic reserve of Bitcoin. But now, over a year in, the reality of macroeconomics is overriding that political optimism.
Promises don't pay the bills, I guess.
Exactly. The Federal Reserve of the United States of America is the elephant in the room. There's growing uncertainty. If rates stay high, liquidity, that easy cash that fuels speculative assets, it dries up. We're watching liquidity drain from the system in real time.
And if the liquidity tide goes out, you find out who's been swimming naked.
And right now, Bitcoin is testing a critical anchor point. If it cannot hold the $65,000 support level, the technical structure breaks down significantly.
And the altcoins.
We're already seeing the spillover. Ethereum and the altcoins are bleeding 5% to 10%. They are higher beta assets. They always fall harder and faster when Bitcoin stumbles.
So, okay, we have a tech crash and a crypto correction. Most sane investors would be moving to cash or bonds right now. But there is one investor, a sovereign nation, in fact, that is looking at this sea of red on the chart and saying, I'll take more, please.
Ah, yes, the El Salvador strategy. This is where the story shifts from, pure financial analysis to high-stakes geopolitical poker.
We are talking about El Salvador. While the rest of the world is panicking, their government is doubling down. The president took to X, what used to be Twitter, to announce, and I'm quoting here, El Salvador just bought more Bitcoin, 1 BTC per day, every day.
It's a fascinating mix of public policy and performance art. 1 BTC per day. It's a slogan designed to rally the faithful.
But it's not just a slogan, it's real money. According to the data from their official mempool portal, El Salvador now holds 7,552 Bitcoins.
And at current prices, that is valued at over $572.7 million.
That's an enormous position relative to the size of their economy.
It is. And notice the timing. They're actively buying into a crash. The asset has fallen, about 7% recently? A traditional portfolio manager would tell you to wait for stabilization.
Right, don't catch a falling knife.
Exactly. This strategy, buying a falling knife, it suggests they are ideological buyers, not just financial ones.
But here's the contrast that I really want to dig into. The government is bullish. Hyper bullish. Conversely, the population seems completely over it.
The disconnect is stark. It's staggering. We have reports coming out of San Salvador indicating that 90% of the population has rejected the daily use of the cryptocurrency.
90%. That is a staggering failure rate for a project that was legally mandated as tender 5 years ago.
It is, and we have to look at why. The initial pitch was all about utility, remember? This will help the poor save on remittance fees. This will bank the unbanked.
I don't know.
But the reality on the ground was technical glitches, identity theft issues with the state-sponsored Chivo wallet, and of course, extreme volatility. If you're a vendor selling puputus on the street, you cannot afford for your day's earnings to drop 10% by the time you close up shop.
So the stability of the dollar is just more attractive for daily life.
Exactly, and the data proves it out. Reports from their Central Bank of Reserve show that remittances sent via crypto wallets dropped 32.5% in 2025 compared to 2024.
Wow, that's not a drop, that's a collapse. Remittances are the absolute lifeblood of that economy, and people are actively choosing not to use crypto for them.
They're going back to Western Union, to MoneyGram, to traditional banks. They are voting with their wallets, and their wallets are holding dollars, not Bitcoin.
Which brings us to the geopolitical drama, because this Bitcoin obsession is complicating their actual survival. The government is currently shaking hands with the IMF.
This is the paradox of 2026, isn't it? El Salvador recently reached a staff-level agreement with the International Monetary Fund for $1.4 billion.
And the IMF has been, to put it mildly, notoriously critical of the Bitcoin law.
Critical is an understatement. They see it as a systemic risk to the country's financial stability. To get that $1.4 billion, the ruling party, the New Ideas Party, had to pass legislation to essentially demote Bitcoin.
So what do they do?
They removed its legal tender status in practice, and they put limits on state involvement.
So they basically capitulated to get the loan.
On paper, yes, they changed the law. However, and this is a massive however, the government just continues to buy Bitcoin. The president tweets, "We are buying 1 BTC a day."
While the IMF agreement says do not use state funds for crypto risks.
It's a blatant contradiction. It feels like they're trying to defy the spirit, if not the letter, of the condition prohibiting the use of state funds for crypto purchases.
It feels like they are trying to trick the bank manager while they're still gambling at the casino.
That's a very fair analogy. And the risks here are existential. Let's just look at the country's fiscal health. Public debt grew 5% in 2025. But the number that keeps me up at night when I look at their books is the pension debt.
The reports say it's over $11 billion.
$11 billion. To put that into perspective, for an economy the size of El Salvador, that is a crushing burden. It's roughly a third of their entire GDP.
Wow.
Imagine if the United States of America had a specific pension liability equal to a third of its total economic output that it just couldn't pay.
It means the government is technically insolvent without external liquidity.
Precisely. So you have a government carrying a massive debt, unable to pay its pensioners without a major restructuring, seeking an emergency bailout from the IMF, and simultaneously using what scarce capital it has to buy a highly volatile asset that its own population refuses to use.
It sounds like a barbell strategy that's gone horribly wrong.
It is an extreme barbell. On one end, you have safety, the IMF, the US dollar. On the other end, extreme speculation in Bitcoin. But the bar in the middle is snapping. Usually, when a sovereign nation is in this level of debt, they de-risk. El Salvador is re-risking.
And if the economics aren't complicated enough, the geopolitics are even messier. We're seeing this triangle forming between El Salvador, China, and the United States of America.
You absolutely cannot understand the Bitcoin bet without understanding the trade map. El Salvador is trying to pivot between superpowers.
And we can see it in the trade data. Imports from China to El Salvador hit a record $3.566 billion in 2025.
That's a massive number. It shows a deepening reliance on Chinese manufacturing and goods. China is effectively becoming the supplier of choice for them.
But in stark contrast, El Salvador is simultaneously pivoting back to the United States of America for its exports. We have reports that they're opening their markets to agricultural products and cheese from the United States of America.
They're trying to thread an impossible needle. They want Chinese goods because they're cheap, but they need the American market because that's where they sell their own goods and where their diaspora lives and sends money home from.
And the political signaling is just wild. We have President Trump in the White House planning to erect a statue of Christopher Columbus outside the White House.
As part of his anti-woke crusade, as some reports describe it.
Right. And El Salvador is trying to align itself with that specific brand of cultural politics to stay in Trump's good graces, even while taking all this Chinese money?
It's a tightrope walk in a hurricane. They are betting that they can charm the United States of America politically while integrating with China economically. But if the United States of America decides that the Chinese influence is too strong, that $1.4 billion IMF loan, which the USA effectively has veto power over, could just disappear.
And speaking of hurricanes, or at least extreme weather, we need to transition to the physical environment, because the volatility isn't just on the charts.
No, the world is literally freezing over in some places.
We are tracking a climate anomaly that is hitting Central America incredibly hard. El Salvador is seeing record low temperatures. In some high-altitude areas, the thermometers has dropped to 3.5 degrees Celsius.
Which is about 38 degrees Fahrenheit. That's breaking records that have stood since 1988.
For a tropical nation, that is a massive shock to the system. And it's being accompanied by wind gusts of 80 kilometers per hour.
Which is about 50 miles per hour.
So what does that do to an agricultural economy?
It devastates it. The coffee harvest is the big concern here. Premium coffee, the strict height beans are incredibly sensitive. The wind just knocks the beans off the trees before they can be harvested, and the cold stunts their maturation.
So on top of the debt crisis and the crypto crash, now you have a supply shock in their main agricultural export.
It's a perfect storm, a convergence of cold fronts, financial and physical.
And it's not just Central America. Up in the United States of America, specifically Florida, we have this bizarre, colorful report about frozen iguanas.
I saw the footage. It's surreal.
The cold is so intense that the iguanas, which are invasive and cold-blooded, they go into a catatonic state and they literally just fall out of the trees.
It's a vivid image. You know, as a financial analyst, I look at that falling iguana and I see a perfect metaphor for the market right now.
Okay, go on. Connect the lizard to the leverage for us.
Think about it. The iguana is cold-blooded. It relies entirely on the external environment for its energy and its agility. When it's warm, when liquidity is high, when rates are low, the iguana is fast. It climbs high. It takes risks.
Just like a leveraged trader in a bull market.
Exactly. But when the environment turns cold, when the Federal Reserve raises rates, when inflation sticks around, when the warmth of easy money evaporates, the iguana doesn't just slow down, it seizes up. Its muscles fail. It loses its grip.
And it falls.
And it falls hard. And that is exactly what happened to Bitcoin this week. That is what is happening to those software stocks. These assets were relying on the warmth of the 2024-2025 bull run. Now that the environment has frozen, the leverage is seizing up and everything is falling out of the tree.
That is a terrifying but actually perfect analogy. The market is raining frozen iguanas.
It really is.
Okay, let's try to find a small patch of sunlight here. We've covered the mess in crypto, the mess in software, the mess in the climate. But there is one area where the Wild West is trying to become a civilized society. Segment 5, the legal frontier of AI.
Yes, this is a very significant development coming from Microsoft. It went a little under the radar for some people because of the PayPal crash, but structurally, this might be more important in the long run.
We've been hearing about the lawsuits for years. The New York Times versus OpenAI was the big one, and the core issue was simple. AI companies scraped the entire internet, took everyone's work for free, and then sold it back to them in a chatbot.
It was theft. Let's just call a spade a spade. It was arbitrage on copyright. They treated human creativity like it was a free natural resource. But that era is ending. Microsoft has launched the Publisher Content Marketplace, or PCM.
So how does this actually work? Is it just some sort of tip jar for publishers?
No, it's a much more sophisticated licensing infrastructure. Think of it as an API for copyright law. It allows AI developers to legally license content from major publishers. We're talking Vox Media, the Associated Press, Condé Nast.
So instead of scraping the data in the dark of night, they're buying it through the front door.
Correct. But the mechanics are what make it interesting. Publishers get paid based on the value delivered.
That sounds like a lot of corporate speak. What does value delivered actually mean in dollars and cents?
Well, that's the controversial part, and it's still being worked out. It's not just a flat fee. It implies a metric where if an AI generates an answer for a user, and that answer relies heavily on a specific article from, say, The Atlantic, then The Atlantic gets a micropayment. It attempts to attribute the intelligence back to its source.
And why would AI companies agree to this? Why would they pay for what they were just taking for free a year ago?
Liability, pure and simple. If you are a massive enterprise, let's say you're a global bank, and you are building an internal AI tool, You cannot risk a billion-dollar lawsuit because your AI accidentally plagiarized a copyrighted financial report. You need clean data.
And by clean, you mean legally authorized.
Authorized, licensed, and indemnified. Microsoft is selling insurance as much as they are selling data. Unlike the move fast and break things era of 2023, this is the move deliberately and sign contracts era of 2026.
And that connects all the way back to the software slump we talked about at the beginning.
It does. Why are software stocks down? Because investors are skeptical about the return on investment for AI. They are asking, is this a real business? By building a legal framework, Microsoft is trying to turn AI from a magic trick into a predictable supply chain.
It's the maturing of the industry. It feels a lot like the shift from, say, Napster to Spotify.
That is the perfect analogy. Napster was fun, but it was illegal and unstable. Spotify came in and monetized the chaos. Microsoft is trying to build the Spotify of AI data.
All right, we have covered a massive amount of ground. Financial crashes, a sovereign debt crisis, frozen lizards, and the future of copyright law. But I want to take a breath and just look at the cultural context. Because even when the markets are bleeding red, people still live their lives.
The distraction economy is a powerful, powerful force.
You had the Grammys recently. Lady Gaga, Karol G dominating the headlines. And down in El Salvador, despite the cold, despite the 32% drop in crypto usage, despite the crippling debt, everyone is talking about the upcoming Shakira concert.
It's telling, isn't it? The financial analysts are staring at the bond yields, but the people are looking at Ticketmaster. The influencers are walking to the venue. The tickets are all sold out.
What does that tell you as a cold, calculating financial analyst?
It tells me that consumer discretionary spending, specifically on experiences, is incredibly resilient. People will cut back on their software subscriptions. They will stop speculating on Bitcoin, especially when they get burned. But they will still pay to be entertained. They will still pay for the distraction. It's where the money hides during uncertain times.
So if we look at the big picture of this entire deep dive, we have PayPal crashing because it's not growing. We have Bitcoin sliding because the cost of money is high. We have El Salvador defiantly buying more Bitcoin despite all the risks. And we have Microsoft trying to legalize AI data. What is the single thread that ties all of this together?
The thread is the repricing of risk and the demand for utility.
Unpack that for us.
The easy money era of 2025 is dead. It's over. We are in a new cycle. And whether you are a nation state like El Salvador or a massive corporation like PayPal, the market is demanding the same thing from everyone. Show me the receipts. Yes, hype doesn't work anymore. You can't just say the word crypto and watch your bond yields drop. You have to show that people are actually using the currency. You can't just say the word AI and watch your stock pop 20%. You have to show a legal, sustainable revenue model. You can't just have a checkout button. You have to prove people are clicking it. The market is done with promises. It wants proof of utility.
So we are moving from the era of the pitch deck to the era of the P&L statement.
Exactly, and that transition is painful, and that is why we are seeing all this red ink.
So here is the question you need to ask yourself as you listen to this.
This brings us to the final provocation for today.
If a sovereign nation like El Salvador, with all the power of the state behind it, cannot force Bitcoin adoption on its own citizens after 5 years, if 90% of them still reject it, does the value of digital currency lie in its utility as money? Or is it purely a store of value for the stubborn?
It's a question that really defines the future of finance. If it's not really money, what is it? And if it's just a digital collectible, is it really worth $70,000 in a high interest rate world?
That is something to mull over while you watch out for falling iguanas. Stay warm out there, everyone.
And keep a close eye on those charts.
We'll see you in the next deep dive.